Analysts are saying we think gold will go to $6,000 or $5,500 or $7,000 or whatever. They're all forecasting higher prices for gold. Yet, for their management accounts, they've got none. It's an extraordinary situation. They need to remedy that. So you will see that by the time they start trying to buy gold for their discretionary clients, there will be very, very little left. And you'll find the gold price will rise really very, very sharply if they start buying.
After the sharp move higher in January, the market has gone through a noticeable pullback, but there is little sign that the earlier rally was driven mainly by excessive speculation. Instead, the correction has not significantly weakened real, underlying physical demand. This points to a market that is being shaped less by short-term trading and more by longer-term investment flows and changing savings behavior around the world. At the same time, the structure of the market remains complicated. Western futures markets still play a major role in setting prices, and at times they can push valuations away from what physical demand would suggest. In London's forward market, gold liquidity remains fairly steady, but silver is in a much tighter position, with more limited supply and less room for flexible trading. This creates a split between paper pricing in financial markets and the reality of available physical metal. Recent global events have also added pressure. Both gold and silver dropped more than 2% as the US dollar strengthened and oil prices rose, following comments from Donald Trump about a possible escalation involving Iran.
Their analysts are saying we think gold will go to $6,000 or $5,500 or $7,000 or whatever. They're all forecasting higher prices for gold. Yet, for their management accounts, they've got none. It's an extraordinary situation. They need to remedy that. So you will see that by the time they start trying to buy gold for their discretionary clients, there will be very, very little left. And you'll find the gold price will rise really very, very sharply if they start buying. So it's going to be a big problem. They're effectively being cleaned out of the futures market. You've got the forward market in London where liquidity, I mean, basically, I think on balance, they're okay in gold. They're not in silver. When I say okay in gold, they're short on COMEX, but long in London. So, net long, they're quite happy with that. But they don't want to go short. That's absolutely clear. And this is really, we saw the markdown in gold in recent days. That's all to do with the expiry of the April contract, which was the active gold contract. That is now pretty much out of the way. So we're now going to see, I think, quite clearly, demand returning for gold, driving prices up. Nobody's got it. They've got to buy it, yet there's none available. So where does it go? There's only one way. And I think that to some extent, the price in China on the Shanghai Gold Exchange and also on the Futures Exchange is actually being set in the West. So we're suppressing the price in our paper markets, which is leading to price suppression there. If that price suppression wasn't there, I would fully expect gold and silver to be far higher. I wouldn't speculate how much, but they would be far higher. That, I think, is the background for gold and silver. The other thing I would mention, which is interesting, is the complete lack of speculative interest in the West. Excuse me, I'm getting over a cold. If you look at open interest on COMEX in silver, it's the lowest it has been for more than 20 years. If you look at open interest in gold, it is lower than it has been since around about 2004. These are, by any measure, heavily oversold markets. When we say oversold, what we really mean is that the level of speculative interest is zero, just about zero. Now, I know there are positions, but they are pretty firm positions, and any move to reduce prices from here is likely to be met with buying. So overall, this situation now, I think, is ripe for a pretty good move in gold. I would say there's one little caveat that I would put in all this, and that is that if I'm right about the Wile E. Coyote situation hitting Japan first, or maybe someone else first, particularly America, then markets are going to crash. In a market crash, in all that pandemonium, there will be a markdown on gold. I wouldn't bank on it. I would hope for it, because as a stacker, my goodness, what an opportunity. But it would be driving things in completely the wrong way. And the reason I think this could happen is that recently I've noticed that the market has been marking gold up when the US Treasury yield drops a little bit, marking it up when the dollar's trade weighted drops a little bit, and vice versa. This is just nonsense. It's complete nonsense. It's a complete misunderstanding of the role of gold compared with credit, which, of course, is really represented by fiat currencies. It is, if you like, the macroeconomic establishment's response to market developments, which just shows their ignorance, real ignorance about the relative position of gold, what gold's function is in a monetary system. They should be looking at the risk in the whole system. And what you're going to get is you're going to get far higher bond yields and far higher gold prices.
Global monetary markets may be undergoing a profound structural change as an increasingly brittle fiat system collides with growing interest in gold as a strategic asset. The actual story, according to Alasdair Macleod, is not just about price objectives, but also about the hidden mechanics of credit, debt, and physical supply that lie beneath the surface. Forecasts indicating considerably higher gold prices in the upcoming years are becoming increasingly frequent. This viewpoint holds that the global financial system has been constructed on increasing layers of unbacked credit, and that as trust in those layers progressively erodes, capital starts looking for assets that are not part of the banking system's liability structure. Macleod suggests that the market is significantly more leveraged than most players are aware of by pointing out a crucial disparity between paper claims on gold and the actual availability of the metal. If even a tiny percentage of investors try to turn paper exposure into actual delivery, this might lead to a significant repricing event.
So the result is that central banks around the world, with the exception of America and the European nations, I mean, the Brits, the French, the Germans, and so on, have been accumulating gold as a greater proportion of their overall reserves. So that makes sense. Now, I would draw a distinction between the relationship between individual fiat currencies and the relationship with gold, which in everybody's common law is real money. There is not enough gold around, if you like, for everybody to get out of a foreign currency and use gold as safety. And also in pure accounting terms, of course, going into gold for a fund manager actually does provide risk, because it could go up, it could go down from his point of view. So I think, that gold is almost sort of standing aside from this. And at the moment, it's being driven by other factors. We've had a very substantial shakeout in gold and silver since January, the January peaks. On that basis, you would have thought that, first of all, speculators would leave the market, but they weren't really in there in the first place. I mean, there was very little speculation, actually. Secondly, you would think that demand, if you like, for physical gold and silver would decline because the steam is taken out of the market, but not at all. I mean, I don't know what you're seeing in America, but certainly what's going on in China is still very, very strong demand for gold and silver. The banks are rationing gold, physical gold deliveries. And only this morning I saw that the Chinese Construction Bank, instead of doing the rationing, like a sort of at 9 o'clock in the morning, if you're there at 9 o'clock in the morning, literally by 1 minute past 9, it's all gone. That's been the situation. So what the China Construction Bank is doing is now running a lottery system. You pay your money in to buy gold, and it's like getting a lottery ticket. You may or may not get it. You probably won't get it. I mean, the point about it, which I think is desperately important to understand, is that the Chinese do understand that gold is money. We don't. We've forgotten that in the West. There is also a very, very strong savings culture in Japan. I mean, overall savings are reckoned to be about something like 40+%. But if you strip out the industrial investment, you're left with household investment of somewhere between 30 and 35%. That is, in dollar terms, an accumulation of between $5 and $6 trillion every year. So where does it go? Well, property is dead. That's of no interest. The stock market is of limited interest, let's face it. It's only recently just about doubled. But really, that's just catching up with what was going on elsewhere. What they've been doing is, the banks have been holding on to deposits by coming up with innovative means of trying to produce a better rate of interest. But at the same time, the People's Bank of China has been reducing its interest rates. So the returns on a bank deposit are very low. But all these banks offer a gold accumulation account which can run alongside your deposit account. So for a minimum payment of something like 500 yuan, which is less than $100, you can open a gold accumulation account. And you can put in a standing order to transfer from your deposit account to your gold accumulation account so much per month. You can see just how enormous, with net savings of, sort of in the order of $5 to $6 trillion every year, what an enormous impact this is going to have on gold. And we're seeing it already. We really are seeing it already. Now, these banks don't take delivery out of the Shanghai Gold Exchange. It remains within the vaulting system, so we don't actually see how much gold is actually behind these accounts.
Alasdair Macleod is drawing attention to a significant gap in the gold market between the public statements made by analysts and their actual financial actions. He notes that a number of financial professionals and organizations are projecting significantly higher gold prices in the future, with some predicting values of $5,000, $6,000, or even $7,000 per ounce. Nevertheless, many of them have little to no actual gold exposure in the portfolios they oversee, despite their extremely optimistic forecasts. According to Macleod, this creates a serious imbalance. If these institutions eventually decide to act on their own forecasts and start buying gold for their clients, they will be entering a market where available supply is already very limited. In that situation, even normal levels of buying could have a powerful impact on price. If large asset managers begin to move in at the same time, the demand could overwhelm supply, forcing prices to rise much faster and more sharply than most people expect. Macleod also notes that recent price weakness was not mainly caused by a collapse in demand, but rather technical factors like the expiry of major futures contracts. Once that temporary pressure passes, he expects real buying demand to return more strongly. The key issue, in his view, is simple. If institutions, central banks, and investors all realize they need physical gold at the same time, they may struggle to find enough available supply at current prices.